Hey everyone, thanks so much for joining me. We are just getting started. We're getting started about 11 minutes later than usual. It's just one of those days, guys. I have to do a bunch of things today, some personal matters to clear up. Had to do something uh, with my mother, helping her with some medical treatments and whatnot. These are all the vagaries of being a middle-aged guy. You got a lot of people to take care of. And what can I tell you? But I didn't want to miss doing the live stream show, albeit this is going to be a quick one. And some of you who stick around are probably like, oh, that's good, Mitch. That it'll be a quick one. So I'll get to the point. So I'll just run the intro real quick. But the gist of it, third really big day of recovery for the stock market. And we've had three huge days in a row. And how significant is it? Does this mean the downturn that we've been seeing since the start of the Ukrainian-Russo war uh, is over, and we're back to the races? The Fed meeting is out of the way, so maybe that was a psychological barrier that we had to get past in the timeline. We're going to talk about a couple of these things, so let's just run the intro. And we're going to talk about a bunch of things, and then we're going to get going. And hopefully, everyone's going to have a really good weekend also. Hey everyone, thanks so much for joining me. We've had a hell of a rally in the market, so let's just take it to the tape. I just want to set up my screen so you'll uh, be able to see it a little bit better. Okay, so let's take a look at the screen. Pop myself up in the corner. All right, Dow was up 417 points. We just had a 599 point up day. Let's call it 600. Yesterday over 500, and today 400. So we've had a 1,500 point jump in the Dow, which probably brings it up about 4 or 5%. Nasdaq up 1.3% after being up almost 4% just yesterday alone. S&P continues to rally, and we even had a rally in gold and oil. So that's kind of unusual. Usually, what happens is you see late. This is just very recent trading. Gold and oil, they back off, and investors run back into risk assets like stocks. We get the flight to safety. Investors run into oil and gold, and they run into bonds. Okay, so treasuries were up today as well. I know you see the negative 0.02 over here, but that's the yield. Okay, the price of the bonds of the 10-year treasury went up a little bit. So overall, everything went up today. I mean, this is just about as good of a day and positive correlation of a day, a positive correlation of assets that we've ever seen. Okay. So we'll just take a look at that. The VIX came down a little bit, down one. It's down to 25 and change. I always talk about this as it goes down. That's positive for stocks, but to really hit new highs in the major averages, we need to see the VIX drop to below 20. Okay. It's got to go below 20, and then we're there. The most interesting thing I'm looking at right now, and again, what you think is interesting, what I think is interesting, could be two different things, but in the world of the market, I want to show you something. This is basically how the yield curve is made. Now, the yield curve goes like this. Okay, positive sloping, lower left, positive right. I don't know how this is looking in the camera, okay, because depending on how the camera's set, but I'm going from the lower left to the upper right. And the yield curve means that very short-term interest rates have a lower yield. Medium-term, short-term bonds have a low yield. Medium-term bonds have a slightly higher yield, and long-term bonds have an even higher yield. But what happens is when the yield curve becomes flat, it means that short-term rates and midterm rates and long-term rates basically become the same. And sometimes you have parts of the yield curve that are inverted, either the whole yield curve or parts of the yield curve. And that means that a short term rate could be higher than a longer term rate. And what I notice here is the 7-year US Treasury is at 218 and the 10-year is at 216. That's a little backwards. Okay. So if you look here, the 1 month is 0.16, then the 3 month is 0.4. Okay. Lots of news here. North Carolina investigating Trump, aid Mark Meadows over voter registration stuff. I'm going to click that off because I'm not getting into the political news right now. So the 1 month 0.16, the 3 month 0.4, then 0.79. You see it's going up 1.2 for the 1 year, 1.9 for the 2 year, 2.16 for the 3 year, and then 2.14, 2.19, and then 2.16. Wait a minute. That's down. That should be like 2.18 or 2.17. And then we get a big jump going to the 20 year. And then the 20 year is actually higher than the 30 year. So there's two spots here. Okay. One over here. And then there's another one over here where a yield on a bond is slightly higher than the yield on the succeeding on the longer maturity bond. And that's an indication that maybe, just maybe, investors are starting to factor in inflation concerns that they maybe don't have to be as concerned with inflation. Okay. By the way, Josh, I see you out there. Ellen, wow, Ellen Miller is in the house. Hey, nice to see you. Thanks so much for joining me. My cuz. And Jay is out there. Thank you so much. Couple of comments. Jay, what do you think about hedging with specs or SPX? Oh, okay, with S&Ps. So Jay says, what do you think about hedging with specs with SPX? You talking about futures? I don't typically hedge, Jay. So just so you know, let's talk about hedging real quick. I don't hedge portfolios for downside, and you might be thinking, well, Mitch, I mean, shouldn't you be mitigating downside? No, let me explain before someone says, Mitch is just 100% long in stocks. Okay, excuse me. I don't want people to think that Mitch is just yelling he's long 100% stocks and he doesn't do anything about that. No, that's not what I mean. There's two kinds of hedging that are part of my asset management practice. Okay. Okay. It's an ETF. Jay says it's an ETF. I guess it's a non-correlated or negative S&P an S&P 500 index, but non-correlated. So it would, I guess, go down. Is that what you're saying? When the S&P goes up? I'll address that as well. What I do is for worries about downside risk, I'd rather be in cash than hedge portfolios. Hedging portfolios is it's expensive, and you have to keep rebuying the hedges because hedges are expensive and they start to wear out after a while and lose value. And over the long term, the stock market has historically risen. There can be no assurance that it continues to rise over the long term, but the entire financial system and all of your money out there and all of your retirement accounts, your whole retirement plans, your estate plans, it's all based on the stock market going higher over the long term. So if the stock market is never going to go higher over the long term, we have some pretty big things to worry about that are probably a lot more meaningful than hedging your portfolio. Not a knock against you, Jay. I just want to keep going with this because you finally gave me, not you finally, I now have something to talk about today because this is such a quick run into the live stream. So I would prefer to raise cash as opposed to hedge a portfolio. So if you're thinking the market's going to go down and you have $1 million portfolio, maybe you'll take $50,000, 5%, and you'll buy something that would go up if the market were to go down. Okay. No, Jay, I didn't beat you up. LOL. Just trying to make a point here. I'm sorry, man. I would come to you first if I ever was going to do any hedging because this is your thing, not mine. Um, sorry about that, buddy. So I get excited. Nothing against you. So for the hedges, so maybe you take 5% of $1 million portfolio, and if the market goes down, you'll have something that you could bet will go in the reverse direction. The problem is something like that, it's not meant for a long-term hold. When you short, like when you have an S&P 500 index fund or one that shorts, okay, thank you very much, buddy. All good. So when you have something, when you're shorting S&P 500, you're using options or some derivatives that have a expiration date, and they have time decay. So you're going to be losing money in your hedges over time. And if you out and out short stocks, you actually have to pay margin interest on those stocks. And the problem with the short is if the market keeps going up, the shorts might not always, your hedges might not always work. But ultimately, you lose money on hedges over time unless you are predicting a pretty short-term market calamity. That's when hedges work best. But the worst thing for hedging is obviously an up market. The second worst thing for hedging is a flat market or a boring market, which is why we always say never short a dull market. All right. So not into that. The negative. By the way, the S&P 500, as you know, it's an index. Um, it's you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. You see, I got the little disclaimer in there about the S&P 500. Yeah. So what you're saying is calamity insurance. What I'm saying is calamity insurance. Yeah, basically that's right. But generally speaking, I mean, how do you predict a black swan event or some calamity or colossal market f up in advance? That's the whole point of insurance is you don't know what's coming. So it's like your auto insurance, your life insurance. Hopefully, these are all a waste of money, and no one ever needs to make a claim. But we never know, which is why you have the insurance, and you have to keep paying for the insurance every year. So over your lifetime, think about all the money that you would have spent on insurance. Can you imagine if you could have had all that money back and had investing it consistently over the last 30 or 40 years? It's the same thing when you hedge a portfolio. It just if it's not something that works out for you quickly, it's just going to cost you a whole lot of money. So for me, hedging is partly raising cash if I'm really worried about a downtick in the market, making sure that clients' portfolios, for example, if a client was 60% stock and now they're 80% stock because the market went up a lot, I would rebalance that account back to 60% stock, and the other 40% would go back to whatever we get designated it for: cash, bonds, short-term bonds, things like that. That's what I would be doing to manage downside risk. The last thing I would use, or I shouldn't say last, the next thing I would use and do use are options, like put options. So to me, why short a stock when you could just buy a put option on that particular stock and define your maximum downside? So these are the things that I do to hedge. But I do find, in my world that, my clients are what you call retail clients. Uh, Generally speaking, these people are not into hedging. They're really looking to just invest for the long term, but hold on to a portfolio of securities that will more or less fit into a volatility range that will help keep them invested over the long term. Not really a matter of timing the market in and out, things like that. I hope that was a satisfactory answer. I feel so satisfied with an answer. Now, what the heck we were talking about the yield curve before, right? So parts of the yield curve are pretty flat because the Fed's raising short-term rates and long-term rates spiked a little bit over 2% on the 10-year yield, on the 10-year. But nothing overly dramatic. By the way, the 1 month T-bill is still 0.17. That should really be about 0.25 at this point. We haven't seen it happen yet. So it doesn't really look like there's a huge reaction in the bond market based on the Fed changing its interest rate policy. All right. Chart of the day. I like to do my chart of the day. This is just a 5-day chart of the S&P 500. Since we're talking about the S&P 500, look at this rip the last couple of days. Okay. Let me see if I could. Yeah, there we go. You see this rip over here? That's a rip. Look at that. And this just goes to show you that when you bail out, try to time the market, think you're really smart by getting some extra cash in your portfolio and saying, I'm going to buy everything back when it crashes. Look, I don't mind raising cash and putting it back into something or finding something else. But most people really should not be doing that with their investments. That's all. That's all I'm saying. By the way, Phil, I see you out there. It's good to see you, my friend. Thank you so much. Really appreciate you joining me. And let's see what else we could take a look at. This is the last thing we're going to take a look at. What worked today? Okay. Energy had a big reversal. So oil took off again today. Building materials were up. Consumer discretionary, healthcare, pretty much just about everything was up on a sector by sector basis. All 11 sectors of the economy went up today. So this is a really strong rally, all encompassing. It's not the kind of rally I like because it wasn't so discerning. And I like a more discerning rally. Like if I see the market rally hard, I want to see the market rally on industrials, on financials, on building materials, on energy. I don't want to see consumer staples and utilities, for example, participate in the rally, because that means now we're just pulling everybody back in. And that's okay, but it makes me wonder how long the rally lasts. So is this bounce from a few days ago that it really started last week, this bounce, is the downturn over in the market, or is this just the pause that refreshes until we go lower? I really couldn't tell you for sure. I think that there's a little bit too much too soon in the rally. We give a little bit back, and then we'll start searching for a new beginning in the market. Okay, how's that? Does that make sense? Sabrina, I see you out there. Hey, hi. So nice to see you. Thank you very much for joining me. I don't know if you've ever joined me on one of my live streams, but I'm really happy you're here. Thanks so much for joining me. And remember, folks, if you have any questions, hit me up in the comments. Words of wisdom, words of encouragement are always appreciated. Anyway, I said I would make this a quick live stream. That's exactly what we're going to do. I'm going to end it here. I'll be back in the live stream on Monday. If you think of anything else that you want to ask me after the live stream, just hit me up in the comments. I'll be sure to get back to you later. Thanks so much.